Hello, my name is Andrew Cook, and today I'll be presenting the findings from our group report. Our report is divided into two main parts. First, we evaluated the performance and risk characteristics of 10 hedge funds, and secondly, we analysed the portfolio that uses an industry momentum equity strategy. First of all, we assessed the performance metrics such as alpha, beta, Sharpe ratio, information ratio, and drawdowns for the 10 hedge funds. These metrics gave us an insight into their risk profile and characteristics. We focused on the drawdowns of the Global Macro Hedge Fund Index, which measures the cumulative losses from peak returns, keeping in mind that significant drawdowns can indicate liquidity problems. Our analysis showed that the greatest drawdown of 27% during the 1990 recession and about 10% in 2008. Despite these, the cumulative return from 1994 to 2012 was 779.31%, demonstrating effective risk management during volatile markets. Next, we examined the factor models for the equity long/short funds using the Fama French factors. On average, beta and the size spread between the small and large companies accounted for about 80% of the return variation. The fund's low beta was due to short positions, and the positive S&P and HML factors indicated long positions in small caps and growth stocks, respectively. Using this, we observed that the univariate alpha was significantly higher than that of the multivariate model, because the former only considered the market factors, neglecting the Fama French factors, thus inflating alpha. In contrast, the multivariate regression incorporated all relevant risk factors for the long/short equity, providing a more realistic estimate of excess returns by accounting for these additional risks. Lastly, we analyzed the convertible bond arbitrage excess returns through univariate and multivariate regressions. The monthly model captured prompt market changes, while the quarterly model filtered out some of the short-term noise. The final model, including a lag terms, had the highest beta of 0.32, as the lag terms increased our ability to assess the strategy's market risk exposure by capturing the delayed impact of market movements on the strategy's returns. Overall, these exercises provided a comprehensive understanding of the performance and risk characteristics of various hedge fund strategies and their market interactions. In the second part of our report, we evaluated a portfolio using an industry momentum equity strategy. This strategy aims to identify and capitalize on macroeconomic trends, assuming that well-performing industries will continue to do so. Industry momentum helps maximize profits by investing in trending sectors and serves as a risk management tool by allowing for portfolio adjustments to avoid economic crisis and diversify risk. However, it also carries risk of market reversals and increased volatility. We started the computing average monthly return for about 30 industries from 1927 to 2010, ranking them from highest to lowest. ELCEQ had the highest average rank, followed by Carry and Serves, while TELCM had the lowest. We then created a winner and a loser portfolio using the top and bottom 15 industries. The winner portfolio provided good risk-adjusted returns, while the market had a higher Sharpe ratio, indicating returns with less risk. Next, we analyzed the long-short portfolio, combining all the cumulative returns and market returns in the graph you can see. The winner and the loser portfolios were the outer bounds of the market return, while the long-short portfolio showed less drawdowns and a more consistent return during the 1930s and 1970 recessions compared to the market and other portfolios. By analyzing the winners and the loser portfolios, we gained a pretty good insight into the risk-adjusted returns through the Sharpe ratio and standard deviation. The long-short strategy may not outperform the market in the long term, especially during high volatility, but it performs well during short-term volatile events. For example, the 2009 global crisis highlighted that the long-short portfolio is momentum-driven. Ultimately, we created an optimal portfolio with the best Sharpe ratio using a mix of winners and losers. In conclusion, our analysis of hedge funds and industry momentum equity strategies provided valuable insights into the performance and risk characteristics. In both parts of our reports, they highlighted the importance of adapting portfolios to market conditions and optimal performance and guiding future investment decisions. Thank you for your attention.